Just about everyone has been warning about the impending economic inflation in recent months. Michael Burry, Warren Buffett, and Ray Dalio, even ordinary people across the world, have seen overall inflation start to rise in almost all commodities and services. Furthermore, the majority of investors expect that inflation will continue to climb at a rapid pace in the future. Cathie, on the other hand, being a classic skeptic, believes the reverse will occur: a deflation. The economy has braced for inflation, but Cathie sees a deflationary crisis as the true black swan catastrophe. This video delves into why Cathie feels this and how statistics supports her assertion. But first, if this is your first video at the Smart Stocks Academy channel, please accept my best greetings. And to be the first to know when a new video like this is posted, hit the like button, subscribe, and click the notification bell next to it. Now, if you're ready, let's get to the video. Cathie Woods is an economist that can back up her statements with decades of expertise. As a result, regardless of any preconceived assumptions, it is very critical that we hear what Cathie has to say. Indeed, two well-known economists, Henry Kaufman and Milton Friedman, believed that inflation was here to stay as early as the 1980s. Cathie Wood, a relatively fresh economist, on the other hand, believed that inflation was slowing. Cathie was correct in the conclusion. Cathie Woods, unsurprisingly, is now making her brave prediction against the majority. The money supply is the first indicator of decelerating inflation. Since the outbreak of the pandemic, the supply of M2 money has expanded substantially. Checks, money market funds, cash, savings deposits, certificates of deposits, and checkable deposits are all included in the M2 money measure of the US money supply. Among all, with the surge in stimulus checks, it is no wonder that M2 money has skyrocketed. Cathie Woods, on the other hand, sees a pattern wherein M2 money growth is slowing rapidly. Money growth in M2 has dropped from 27% back in April to only 17% in May of 2021. The bond market has been surging in recent months due to this slowing in growth. After peaking at 1.7% in March, the 10-year Treasury bond rates have been slashed to below 1.5%. Because bond rates and prices are inversely connected, the bond market has been surging as yields have been falling. We understand the bond market is forecasting deflation rather than inflation when this happens.
Monetary policy, the growth rate in M2 peaked at 27% earlier this year and has dropped to 13.4%. Last month was a little lower, but low teens now.
You could believe that the bond market has already been surging as a result of the Federal Reserve's artificial purchasing power. The federal government, on the other hand, has been buying bonds for months, but this isn't a new factor in the bond market. The federal government's purchasing power has remained constant throughout time. When the bond yield soared in March, the federal government's purchasing power remained intact. In fact, the federal government plans to sell certain corporate bonds and corporate bond exchange traded funds, or ETFs, that it acquired during the outbreak. Cathie Wood, like every other economist, anticipated the bond market to fall after the strong inflation figures. Despite this, bonds, nevertheless, continued to increase.
I would have expected the bond market to continue to sell off and interest rates, therefore, to go up. Instead, since the end of March, the 10-year Treasury bond yield has dropped from 1.74 to 1.43, no matter how strong the economic data have been, how high the inflation numbers have been.
Cathie Woods, as strange as she may appear, believes inflation will continue for the next few months. Prices grew 1.6% year over year in February to 3.9% in May, according to the Personal Consumption Expenditures Price Index. Cathie, on the other hand, believes that this inflation rate may rise up to 5%. So, while inflation may pick up in the coming months, Cathie expects prices to fall in the long run. Ironically, the spike in oil prices is preparing the environment for deflation. The Organization of Petroleum Exporting Countries, or OPEC, a collection of numerous countries that control oil supply, is determined to recoup some revenues by keeping fuel supply short. And it is possible that this is counterproductive. As gasoline costs have risen, an increasing number of consumers are opting for electric vehicles. EV sales have surged hugely disproportionate to fossil fuel car sales even during the outbreak. And this is motivated by rising gas prices as well as the notion that electric vehicles are far better than gasoline-powered automobiles. And if petroleum prices continue to rise, more people will be encouraged to buy electric vehicles, reducing long-term codependence on oil. Crude oil is now trading at $75 per barrel, close to the previous record of $77. Cathie believes that oil would finally fall between $3 and $12 per barrel. That's true, a barrel costing only $3 to $12. This price of $12 a barrel is an 84% reduction, and if these cheap costs become a reality, there will be significant deflation.
OPEC, and they have about 5 million spare barrels they could produce per day. They're not. They want to keep the oil price high enough so they can fund their budgets. But at some point here, they may end up killing demand. When they start seeing demand destruction because of pricing, I do think they'll start producing. And as you know, longer term, the combination of electric and autonomous electric vehicles, we think, is going to drive oil prices down. As I've said, now this is my point of view. We haven't done the research to get us here yet, but I think we could go down, back down to where oil prices landed after the cartel took over in the early 70s. And they went from, I think, $3 a barrel or $4 to $12 a barrel.
The buying power of the US dollar is another piece of evidence that indicates deflation. The dollar index has risen dramatically in the last month. This is in marked contradiction to worries of dollar inflation, as the dollar is acquiring buying power in comparison to other currencies. And this might be due to Biden's lower than expected corporate and capital gains taxes. Moreover, goods have been crashing recently. Lumber costs, for example, have taken a sharp, steep dive, which Cathie Woods anticipated prior to the collapse. She acknowledges a couple of other indicators in the following clip, including China's food prices and metal costs.
The consensus short in terms of currencies was on the dollar at the beginning of this year, and the dollar is not going down. And that's also consistent with the bond yields coming down, surprisingly.
Public demand is the final aspect to consider. Month on month, actual consumption falls by 0.4%. Usage of durable goods is down by 4.3%, while utilization of non-durable products is down by 0.5%. Services demand, on the other hand, is only up by 0.4% month over month, which is not quite as significant as the fall in products consumption. Overall, as seen by the drop in commodity prices and the slowing increase of the monetary supply, inflation may not be quite a significant concern as you believe. But there are several opposing opinions on the other side of this discussion, such as Ray Dalio's demand for the bond bubble to burst and Michael Burry's belief that high inflation is on the way. Personally, I expect that inflation will not be an issue in the long run. However, inflation may be greater than projected in the short term. as demand rises across the spectrum. I would love to hear your thoughts about this at the comment section down below. And that concludes today's video. If you haven't already, show your love and support for this video by clicking the like button, subscribing, and clicking the notification bell next to it to be the first to know when we post a new video. Thank you very much for taking the time to watch. We hope you enjoyed it, and we look forward to seeing you on our next video.